Thank you very much, Friederike. Welcome to all of you. I'm very, very happy to be here on this, at least in Dresden, sunny Friday afternoon. I'm looking forward to presenting the results of a study that my colleague Malte Bleeker and I have carried out recently and to discussing it with you. Just give me a minute so that I can move over to the slide presentation, and then we can start the session. And I hope that you can see my screen. And the first slide that again concerns the study about the relationship between macroeconomic and financial market indicators on the one side and luxury revenues on the other. So the question is, for instance, if the Nikkei goes up, what happens to luxury consumption? What if GDP USA drops? What are the implications on the consumption of high-end goods? This was a question Malte and I have been concerned with for many, many years. And one way of trying to find an answer is to look at the data. So what we did is we had a look at the annual sales of some very important stock-listed luxury brands and certain parameters. And the details I would like to explain with you now. We started with three questions or research thesis. The first one was, macroeconomic and financial market indicators are strongly correlated with revenues of high-end brands. That was the first question we asked ourselves. The second one was, those economic and financial market indicators, are these suitable as a basis for long-term forecast and strategic recommendations for action in the high-end market? So if we have an idea about how the S&P 500 moves in the future, are we sure that this would mean that for luxury we will benefit from higher sales, from higher revenues? And thirdly, here I was a little bit too fast. Macroeconomic and financial market proved to be unreliable. That was the third thesis for short-term and medium forecast and operational management decisions due to perhaps volatility or low correlations. So those were the three questions we asked ourselves, and then we started to assemble all the necessary data to give you some indication, a comparison of those macroeconomic and financial market indicators, which we would call for this session, for this presentation, variables set 1, with revenues of high-end brands, variables set 2 from the years 2001 to 2023. The basic statistical criteria we choose was the Pearson correlation coefficient R with 2,280 comparison based on absolute values, based on annual change in these values in percentage, and thirdly, a comparison by rank. The significance was at level alpha at 0.05. The currency conversions in euros are based on annual historical average rates. The high-end brands data available for at least 10 years. Not all brands could be traced back to those 23 years. Some only provided data for 10 or 15 or 20 years. So the minimum was 10 years and larger than 10. And finally, the sources we took advantage of were the, of course, annual financial statements of high-end companies, Bain & Company, Bloomberg, the German Federal Bank, the Federal Reserve Bank of St. Louis, LifeX, which is providing data for the wine industry, the OECD, the Swiss Watch Federation, Standard & Poor's, and other sources as well. Before we start to analyze the numbers as such, for those who are not too familiar with the statistics, the Pearson correlation coefficient measures the strength and the direction of the linear relationship between two continuous, normally distributed variables. It ranks from -1 to +1, with 0 indicating no linear relationship. Now you shall see an example in a minute. It is calculated as the covariance of the variables divided by the product of their standard deviations. I will not go too much, or not at all, into the details of this, but just to have provided the mathematical formula that measures the Pearson correlation coefficient. This coefficient measures correlations, and that is important to note, but not causations. Here's an example. So if we take the sunshine and we measure it in hours, we could compare that with the consumption of ice cream in kilograms, or we could compare the sunshine measured in hours with the numbers of sunburns. These would mean that we are looking for causation, where we have a direct relationship between the sunshine and the consumption of ice cream, and the sunshine and the number of sunburns. Now, no one would believe that the consumption of ice cream is creating sunburns, likely not. But as we can easily imagine, the more the sun shines, the more there is the consumption of ice cream. The more the sun shines, there are more numbers of sunburns. So both phenomena are positive, are raising due to the sunshine, and therefore we could compare these two numbers, consumption of ice cream and number of sunburns, and that is measured by correlation. To give you an example of our study, let's compare Mercedes-Benz and the gross domestic product of the world. Those are the numbers, Mercedes-Benz in €1 million from the years 2001 to 2023. And then as the second variable, we have the GDP world measured in billions of US dollars. So we have the absolute numbers and we have the change in percentage. And in the study, we were looking at the absolute numbers and also at the annual change of those numbers measured in percentage. And that is quite important to later on understand the results of the numbers. So if we look at the correlation of these absolute values, we would get an R of 0.868, which indicates a strong correlation between Mercedes-Benz global revenues and the GDP world in those 23 years. And if you look at the graph, you will see the GDP world in orange dots and Mercedes-Benz in blue dots. And well, just looking at the graph, yes, they seem to be very close. Now, if we take instead the annual change in percentage, the R shifts to 0.037, which indicates hardly any correlation, almost no correlation. And you see that these dots are much more dispersed. And why? Because if we look, for instance, at the year 2007, 2008, Mercedes-Benz in terms of revenues declined in 2007 by almost 4%, and the next year by minus almost 9%, whereas GDP growth was 12%, almost 13%, almost 10% in the year 2008. So it is important in measuring correlations, what are we looking at? And we can take the absolute numbers or the change in percentage. The third one, we could also look at ranks in ranking those absolute numbers in order, but that results basically with the same yielding the same results as with absolute numbers. So because we don't have too much time today, I will only focus on the absolute numbers, on the change in percentage, but not on ranks. So this is an example how the study was built. Now, what are the variables that we have looked at? Variables set one, the macroeconomic and the financial market indicators, GDP, USA, China, world, Europe, Japan. We had a closer look at the distribution of wealth in the United States of America. We had a look at financial indicators such as the S&P 500, the Nikkei 225, S&P Global Luxury Index, the Euro Stoxx 50, Shanghai Composite, and the Bitcoin. And we also looked at US real disposable income and US personal consumption. And to finish that list off, OECD consumer confidence in the USA and in China. On the other hand, the other set, we had a look at 29 high-end brands, starting with Armani and ending with Tod's, and their annual sales. We added the Bain and Company statistics that are published every November, telling us about the volume of the luxury industry. And then we have the Life X indicator, which measures prices of fine wines globally. We then restructured the data of the luxury brands, the high-end brands, and summed them up. We had a look at those numbers as far as they concern Asia, the US, Europe. We had we measured the results for high fashion, cosmetics, watches with an export value of plus 3,000 Swiss francs, watches between 500 and 3,000 Swiss francs, and the automotive, the car industry. Now, to be honest, this is a study, and to me, it is always important to indicate the limits of any study. And now, as this is something that was carried out by the Institute of Marketing and Customer Insights, thus providing a scientific research background, I think it's only fair to indicate the limits of interpretation of the following results. First of all, the range of variables is selective. We choose those 19. We could have chosen others, and perhaps the results would have been different ones. The same accounts for the set number 2. We basically choose them because those were the ones with public figures, with public numbers available, the stock listed companies. Which that does not necessarily mean that they represent the whole world of total consumption of high-end cars, watches, or designer fashion. The figures for all companies were not available always for the entire 22-year observation period. The revenues may have been influenced by investments, de-investments. If we look at LVMH within those more than 2 decades, obviously, Mr. Arnault has acquired a lot of brands, thus inflating the revenues of LVMH. Other groups may have divested brands. There may have been accounting methods that have changed. Sometimes it wasn't too clear whether shoes as a category were summarized under fashion or under leather products. So yes, there are some limits to interpret the results of our study. However, in total, we believe they are nevertheless representative to get an idea about those correlations between macroeconomic and financial market indicators on one side and the luxury industry on the other. Now, if we speak luxury, actually, we mean high-end brands. I don't want to venture into a days-long discussion about what is luxury. So to make things easy, in the study, we are talking about high-end brands that summarize prosuming brands, luxury brands, prestige brands, and premium brands. Going through the annual reports of all these 29 brands, there are no definitions provided whether within those portfolios the brands are more presuming or luxury, prestige, premium. Thus, we have had a look at high-end brands, including luxury. Now, let's get into the results. And I give you a minute to absorb the numbers. What you're seeing here is the percentage of variables of set 2, which means the brands, that correlate moderately to strongly, thus with an R bigger than 0.6, with the variables of set 1, which is, again, GDP USA, GDP China, the Nikkei 2022. So if we look at the first column, group and brands, we see GDP USA, and 93% of those 40 variables of set number 2, the brands, the Bain index, high-end watches, 93% correlate with a factor, a coefficient of 0.6 and above, which is a very high number. So most of the variables of set 2 do correlate with the GDP USA. And the same applies for real disposable income in the US, GDP China. So I give you a minute to have a look at the numbers, please, so that you can familiarize yourself with the results of the analyses. Now, what is important, again, to mention, the criterion are annual sales, so the absolute numbers. So if we compare the revenues of the luxury industry, we take these annual sales and compare them with the numbers of, let's say, GDP Japan or the Euro Stock 50. They quite often correlate more than moderately with the macroeconomic and financial market indicators. But those are the absolute numbers. If we look at the regions, this correlation, or this percentage, I should rather say, is much higher, is even higher. All of the 40 variables of the set number 2, the brands, the categories, the regions, correlate with a coefficient of above 0.6% with GDP World, with GDP USA, GDP China, and so on. And the same applies for product categories. If we look at watches, if we look at high fashion, if we look at the car industry, all of these indicators correlate with a coefficient of plus 0.6 with those macroeconomic and financial market indicators, with some exceptions. So if we look at the bottom of these 3 columns, what we have found out that the OECD consumer confidence USA or OECD consumer confidence of China do not correlate at all, or basically not at all, with those brands and categories or regions. The same applies for the Shanghai Composite, which is due to the fact that, well, basically for political reason, the stock exchange in China was regulated, and therefore not showing the same positive trend as we have seen it at the S&P 500 or the Nikkei 2025 or the Euro stocks. So there are differences, but overall, if we just look at the annual sales, what we see is that many brands, many regions, many product categories are correlated with those indicators. Now let's take the other criterion, which is the annual change. And here the picture is different. If we look again, groups and brands, and ask ourselves how many of these 40 variables correlate with an R bigger than 0.6, there are only 45 instead of 93. US personal consumption drops to 41. And then there's even a steeper drop to GDP world, Japan, and all the other factors. And basically, we see the same results for regions, and we see the same results for product category. And that is an interesting indicator. So what we can say here is that long term, the luxury industry moves into the same positive direction as the macroeconomic indicators and financial market indexes. And looking back at those almost 25 years, yes, indeed, we have observed, all of us, that the economies developed. China was developing, Russia, Middle East, there was growth, constant, basically, with a few exceptions, constant growth in the US and also in Europe. But if we look at the annual changes, here the picture is different. Now we could inverse the analysis and now ask ourselves, okay, how does Brunello Cucinelli correlate with these financial market indexes and the macroeconomic indicators? And if you look at the first column, correlations, absolute value, and there you take the sub-column, the third one, moderate to strong. Brunello Cucinelli is moderately to strongly correlated with the 19 variables of set number 1, 84%. We would see this strong, rather strong correlation. Moncler is the same, Chanel. So if we go through that list, in absolute numbers, again, we see for quite a lot of brands, those correlations, stronger correlations. But again, if we look at the annual differences, here the same picture, only in much fewer cases there are those correlations. So only 21% of those 19 variables of set number 1 do correlate moderate to strongly with Brunello Cucinelli. So again, and it makes sense in a way, the overall direction is the same, it's positive, yet if we look at the differences year per year, then some brands have grown stronger, some have grown less strong, and then I will provide the interpretation of these numbers in a minute. But looking at the numbers, we see a gap between the absolute value and the annual difference. And that also concerns the regions and the categories. So the low percentage can be explained with brands that have a strong product focus and therefore are not representative for the luxury industry as such, have a strong regional focus, or experience business difficulties. So indeed, we know brands that had good years and not so good years, and obviously each single company may face times when the overall business is strong, where the global economy is strong, yet due to management mistakes or other incidents, the numbers of that particular company or brand are less strong. And we have seen that at the beginning of the presentation with Mercedes-Benz. Mercedes-Benz not always followed the general evolution of the global economy. So if we really look at try to find examples where on an annual percentage change, not looking at the absolute numbers, but the percentage change, thus with an R of bigger than 0.8%, we can only find 6 cases out of 551 possible ones where we would have a strong correlation. And that concerns Armani and USA GDP, Hugo Boss, also GDP USA, Brunello Cucinelli, Armani, Hugo Boss, Ferrari for US personal consumption. Otherwise, looking at the annual percentage change, no, there are no strong correlations at all. And that again provides the same result of if we look at the annual absolute numbers, yes, the industry and most of the brands move into the same direction, yet on an annual level, this may not be the case. Now, let me please present a little case to make a point. We have analyzed the US-specific macroeconomic and financial market indicators with the sales of LVMH from those years 2001 to 2023. And here again, if we look at the correlations, absolute value, there is a strong correlation between LVMH sales and US personal consumption, GDP, US wealth, S&P 500, US households, wealth of the top 10 percentile, and. And if we look at the annual difference in percent, here we only could find 2, which is US personal consumption and GDP USA. And that is interesting, and that starts to lead us towards the interpretation of these numbers and the question, what actually how do these numbers serve us in business planning? Because that is the idea. If we understand the correlations, maybe if we have a very accurate forecast of GDP USA, then we already have a forecast for LVMH revenues in the market as well, and the same for Porsche or the same for Tod's, what brand soever. So if we look at the correlation between GDP US and LVMH and the personal consumptions, which are the 2 only ones that are strongly correlated based on this annual change in percentage, we see here the graph to it, and yes, it looks that LVMH US sales are quite aligned with GDP and personal consumption in the US. However, and I'm now starting the process of providing interpretations of the numbers. We can look at the numbers as such and say, well, that's cool. So if GDP in the US moves up, then so will revenues of LVMH. Not so fast. I think one important outcome of this study is that we are aware that, yes, we have those numbers, but looking at them in an isolated way will not help us too much. This is I believe, quite interesting graph about the distribution of US household wealth from 2000 to 2023 in percent. So the top 10% percentile of the US population, or to put it simply, the 10 richest of the US population own some 66% of wealth in the year 2023. And it was more or less the same case some 22 years or 23 years before. So what we see here is a distribution of wealth that is very much cemented, hasn't moved, regardless the president, regardless the Republican or the Democratic administration. Now, so why is this additional information important in the context of our study? Yes, there is a moderate correlation between the development of GDP and personal consumption in the US and LVMH revenues from 2001 to 23. And yes, intuitively, that is obvious. LVMH is a large group with many brands, from perfumes, champagne, lady bags, watches. And this large offering represents high-end spending of wealthy US Americans and middle classes. So indeed, as with all the results that I have tried to explain, yes, we all thought if GDP moves up, luxury will move up as well. And that indeed is the case in the long run, even though on an annual basis, the picture is a little bit different. However, looking just at those numbers plus the distribution of wealth in the US, I would have some strategic questions. The question are, what is or are the long-term future business drivers in the US for LVMH? How will health and income distribution develop? What will be the impact of currently and likely to persist negative demographics? The US population is, as a matter of fact, shrinking. Not shrinking, but getting older. How will reduced immigration shape the US economy? How will growing inheritances put a potential consumption fatigue among the top 5 wealthy play out? What do I mean by that? Well, if the number of people remains the same who own a certain percentage of wealth, will they buy their 10th villa? Will they buy their 20th Bentley? If the number of middle classes remains more or less the same, will we be able to sell more Chanel No. 5 to the masses, to the volume business? So if the US population is cemented in terms of wealth distribution and not growing, what are the implications for LVMH? So what are the long-term answers and preparation for its USA business? And please give me a few minutes. I'm happy to provide a few answers. But looking at those numbers and adding other microeconomic and financial market indicators, complete a picture where we would say, yes, we all hope that GDP in the US will rise again, and hopefully so will be luxury revenues. However, there may be influencing factors that we also need to consider to steer 90 billion euro revenue business long term. And in my projects with my clients, I'm always making this little exercise. If we look back 25 years ago, that seems like yesterday. We all have memories where we were 25 years ago. The past is relatively present. Now, if we look at the next 25 years, we have no clue. We have no answers. We are insecure. However, it's the same span of time. 25 years in both cases. So although we are quite sure about the past, we are not sure about the present and the future. And therefore, it is very important, even though if it is quite obvious that the GDP in the US will trigger, hopefully trigger more luxury sales, we are not sure. And there will be new factors. So if we look at the development of the luxury industry, yes, this study will help to say, indeed, there is a correlation between macroeconomic and financial market indicators with revenues of high-end brands. And yes, long term, these numbers give us confidence that if the global economy performs well, so will likely the high-end industry. However, as we have seen, short term, those indicators do not help us to make the forecast about Mercedes-Benz, about Ferrari, about Hermes, about other brands, because the volatility from year to year is much stronger than the change of GDP US, which growth by 2 to 5% only, or China or other indicators as well. Since 1990, the high-end industry has enjoyed a very long cycle of strong and quite resilient business growth. And it has been carried by 4 very particular mega boosters: new markets and internationalization, China, Russia, Middle East. We have seen that there were incremental revenues and margins through vertical integration along the value chain. For instance, brand boutiques. We have experienced the online and logistics revolution, home shopping. And fourthly, the industry took advantage of line extensions. However, in the future, there will not be equivalent business leverage. Those boosters are played, and the luxury heydays, to my point of view, are over. We will have to face a very different setup of markets and the global economic frame that we need to be aware of to steer our business professionally. And indeed, if we look at the share price evolution of just the last 5 years, the investors agree. These are the share price of 36 stock-listed brands. And if we look at the overall growth rates, only 9 of them did beat the S&P 500 or the Nikkei 225. So luxury is not detached from realities. And there will be new challenges. GDP US will not save the luxury industry alone, because the US will change, as China has changed in recent years. So some recommendations for the luxury industry under a new setup. I believe that we need to go back and understand the very essence of high-end, and especially for luxury. Less is more. Second, we have to look at the topics of opportunity and threat to monitor business practice and research. And the numbers I have presented to you indicate opportunity if GDP Japan grows, if GDP China grows, growth. But at the same time, coming back to the little example of demographics in the US, there will be threats. Generation Alpha, yes, will inherit a lot of money, but are we sure about saturation? The impact of global demographics. China is expected to have only 700 million inhabitants in the year 2100 and some 850 in the year 2050, which represents those 25 years I was talking about. Yes, Southeast Asia promises new wealth. Same for India. But are we sure about the distribution of wealth? If we look at the example of Indonesia, a strongly growing economy, but the distribution of wealth is rather concentrated. So even if Southeast Asia is growing, it does not necessarily mean that we have new luxury consumers. Places of political instability. I mean, that's the lesson we learn these days once again, or since Russia has invaded Ukraine. And then there's the major topic of ESG, environment, social, and governance. So there are topics we need to look at and must not naively believe that GDP growth alone will secure us our future. And that will have implications on management. We, I guess, need a different setup of management structures and processes. And the benchmark here are the fast-moving consumer goods because the industries of chocolate and toothpaste, etc., are used to work under stagnant and saturated market conditions. And here, I believe, in the years to come, we can learn a lot in the industry. Now, looking at the numbers, I believe for many brands in the years to come, the question will be up or downgrading in avoiding stuck in between situations. And the discussion is taking pace about mid-priced brands that are squeezed, and therefore for the whole industry, yes, I believe there will be opportunity for the volume business and for the very high-end business. But if I look at industries such as watches, jewelry, or cars, where we have substitutive effects through innovation, and smartwatches, lab-grown diamonds, the e-motors, where we see that in the mid-price is put more and more under pressure. 5, relevant and attractive customer-oriented positioning and emotional storytelling. I guess this is the biggest booster where we can reconnect with the customer more strongly. Yes, understanding that we need to do more to segment our business according to well-defined target groups. That is something that the industry, in comparison to fast-moving consumer goods, has not really found out yet. New markets, obviously, we will size opportunity in Africa, Southeast Asia, and India. Investments into branding, realistic forecast and commercial discipline, sufficient budgets. So that is what I had intended to present to you today. I hope it was interesting, useful, and I'm very much looking forward to your questions. But before I do answer your questions, let me please just inform you about the Luxury Summer School, which will take place from August 11th to 14th at the University of St. Gallen. And it would be fantastic to see you there then personally to discuss luxury and its future. So yeah, let's start the Q&A session. And again, thank you very much for having listened so far.
Thank you so much, Frank, for putting some sense in all these correlations for us.
I hope.
Yeah, for all of you who have joined later, of course, you will receive the slides and also the link to the recording next week. We have received a few questions already. I'll just start asking them. Please, as I said, feel free to use the chat or the Q&A anytime to pose more of your questions or comments. I'll just start at the top. Thank you, Nissa. Also, thanks for joining. It's about one of your slides where you pointed out initially the correlations. Can it be that the correlations are defaced by 1 year or some months? For example, GDP growth on year 0 follows a growth in the consumption of a brand in year 1. And a quicker correlation of a decrease in GDP leads to a sooner decrease of consumption, for example, 6 months later. So could it just be a delay in the correlation?
Possible, but I don't think that the overall outcome would be any different. The issue with the data is the revenues of the brands are only published once. Yes, sometimes they're quarterly results, but then that is not the case for all. For all brands, Swatch Group publishes twice a year, and so trying to analyze that on a monthly basis, then we would lack the data.
Thank you. What do you think, Frank, about AI being, for example, a help to better understand what luxury consumers want as a product and also allocate better geographically or the goods size-wise, just generally about the growth drivers?
Again, at the beginning, I didn't understand you, Friederike.
Sorry, what about AI? Could it,
AI,
for
yes.
example, yes.
Of course, and obviously there are brands that are already using AI for forecasting, for analyzing data, but that only concerns a small portion of the industry. And I hope that AI will provide better answers because one of the sins, one of the diseases of our industry is that first of all we don't use data enough, and second we are not summarizing the data into the right information, leading to smart forecasting. The industry overall is too ambitious, which I understand. They are stock listed. You have VP sales that want to earn their bonus. So it's a pushy industry. But the very essence, the nature of luxury is the opposite. Less is more. Exclusivity, uniqueness. So one of the combats of the years to come will be the ability to forecast business better and therefore to plan stocks better, production and stocks better, to align demand and the offering in a more intelligent way. I think that will be one of the major tasks. And here again, fast-moving consumer goods are well advanced, and here we can learn a good lesson.
Thank you, Frank. Here are 2 questions about the luxury services or travel industry. Do you see any correlation there? Companies will definitely need to shift the focus from consumption to FMCG products to experiences and storytelling. It would be very interesting to see this correlation in the world of luxury travel as well, especially medical tourism. Do you have any insights or views on that?
Unfortunately, indeed, very interesting question. I wish we would have, Malte and I, the data. There are data available about the international flows of tourism, of course. Yes, we have seen medical tourism shifting from some 20 years ago. I recall Germany was a hotspot. Now Turkey is one. In Southeast Asia, there are hotspots. So if I only had the data, I would love to run the analysis, but unfortunately, I don't have.
Excellent. By the way, your co-author Malte is with us today. So Malte, if you have any additional insights, feel free to jump in or just unmute yourself. Here's a question from Tobias Steiner. What is your estimate in transferring those results into the B2B market for services that are perceived as luxury but are not necessarily luxurious? In addition, I wonder if your results rather measuring if a brand actually is a luxury brand or just perceived as such by a less affluent customer base.
Well, two complex questions. The easy path was
Still
simply
have 7
to take
minutes.
the numbers. We simply took the numbers available, and obviously it's as well academic as practical debate about what is actually luxury, and looking at the terms such as affordable luxury, ultra luxury, hyper luxury. There's even premium luxury. What is prestige in comparison to luxury? We had actually a seminar on this one, the Institute and myself, Friederike, I think 18 months ago, where we discussed what actually is luxury. But in this study, we simply took the numbers of those who can be considered high-end and to see whether there's a correlation between revenues of these brands and the macroeconomic factors. The first question, please, if you could repeat, Friederike.
What's your estimate in transferring your results into the B2B market for services that are perceived as luxury but are not necessarily luxurious?
I don't have the data, but assuming that the B2B business follows the B2C business. So supply chains, service partners are affected what is happening in the B2C business. But here again, unfortunately, we don't have the numbers, and that would be a good question for a follow-up study.
Great. Thank you, Frank. And by the way, we still have the recording from our past webinar on what is luxury, as it's a rather timeless question. I can send along the link with my follow-up email next week. No new questions have come in so far. So you could use those last minutes or seconds to post the questions. Otherwise, I would really like to thank you for your attention, for spending your lunch breaks with us. If you have any questions later on, don't hesitate to contact us anytime. Especially Frank is very valuable to follow on LinkedIn. He provides industry views, constantly. And of course, we would love to see you perhaps in August for our luxury summer school here in St. Gallen. Thank you to you, dear Frank, for taking the time. This has been
thank you all.
Very
Thank you very much. Have a great weekend.
Yeah, and have a great weekend. And we hope to stay in touch. Thank you very much. Bye-bye.